Hey, would you like to rent your current home and then go buy another home? And maybe you're worried about the financing and how that might work. I'm here with Peter Lindquist, a great realtor in the Twin Cities. He's going to help us understand the complexities here on financing your next home while renting your current one. My name's Travis Anderson. Let's get right into the video. So, Peter, in the last couple of videos, we talked about keeping our current residence, turning it into a rental, and then buying a new home. Most people are going to have questions about financing. How do we make this a reality?
Yeah, and that is a concern for people. How am I going to qualify having two mortgages? Well, if you do qualify having two mortgages, then this question is easy. You can buy the new house using minimum down payments in most circumstances. I say most circumstances because if you have currently an FHA loan, for example, and now you're going to go buy with another FHA loan, there's many provisions there that we have to work through because in general, you can't have two FHA mortgages unless certain circumstances apply. Or if you've got your current loan is VA and you're buying a new house VA, that can only happen under certain circumstances. But if your new loan is conventional and you qualify for both, that's easy. But let's talk about if you don't qualify. So now how does that end up working? And that varies based on the program under which you are using to buy the new house.
If we don't, you mean if you don't just debt to income, credit score, et cetera, you don't qualify to carry the two debts. And so now what you're saying is you still might be able to make this happen?
Yeah. And it requires some planning in order to make it happen. So let's make this easy. You're buying a new house using conventional financing, but with your old house, your debt to income ratio is too high. So you have too much debt in order to qualify for the new house. How do we combat that? The way to combat that is if you can get the old house rented prior to the closing on the purchase of the new home. So that typically means you get a lease with a start date that is on the day or within a month after the date of closing, and you receive the first month's rent and damage deposit. In most cases, we can count a portion of that rental income that you're going to be receiving. We can count a portion of it to offset the old debt. The portion that we can use is 75% of it. Let's make this easy. Let's say your old house payment is $1,500 and your rent that you can collect is $2,000. So now 75% of $2,000 is $1,500. So if I can verify that you have rented out the old house and you're using conventional financing to buy the new one, now I get a lease and I get copies of your checks that you've deposited for rent and damage deposit from the new renter, okay? And we're going to count $1,500 of that rent to offset the house payment of $1,500. So you are qualifying for the new house without even that old house hurting your debt to income ratios at all. Do you understand what I'm saying with that?
Yeah, I think I understand. So is it that you actually do remove that? Because like debt to income's a percentage, right? And so now you still have the debt, you've increased your income, but are you saying that you actually just remove that from the calculation because it covers the full mortgage payment? Is that right?
Yeah, in that rare circumstance, effectively, okay, you're removing it. But what's more common is, let's say that it's $2,100, or no, let's say that it is $1,800 of rent. Now we're going to use 75% of that to offset against your rental payment. And that's going to be, I don't know it off the top of my head, about
$1,500
versus the $1,500 of rent. So now we count $150 of that mortgage debt against you in your debt to income ratio. So it's better to think of it as we're going to use that rent to offset the mortgage payment to see what you end up qualifying for.
Yeah. So in other words, generally speaking, you're going to use all of the debt from both mortgages and car loans and student loans and everything else, all of that debt, and you're going to divide that into their income, and that's going to give you some percentage. And they have to be below some percentage in order to qualify, right? Okay.
Right.
In the event that we can get it rented, a portion, 75% of that rent amount can go against that debt, and we'll only use the difference on that first mortgage on their current home. Am I hearing that right?
Yeah. Yeah. And only under certain limited instances we can use, if it's an overage, can we count that rental or that overage towards income? Let's not get into that, but they're under limited instances. So that's if you're using conventional financing to buy the new house. If it's an FHA loan you're buying, it gets a little hairy, especially if your old house is FHA. Now, the situation is that you have to be at least 100 miles away because FHA traditionally only allows you to have one FHA loan at a time. They will allow you to have more than one FHA under limited circumstances. So that's one rule, have to be at least 100 miles away from the old residence. And even then, you have to have equity in the old house. You have to have at least 25% equity in the old house. And so we would actually have to do an appraisal on the old house in order to use that income. And then you also need a lease. So with FHA loans, this gets to be considerably more complex if you want to buy and keep the old property.
In the event that you have an FHA mortgage on your current home, you're going to use an FHA mortgage on your next home, and then obviously keep the current home for rental. In that instance, we've got these other guidelines, and I assume you're hitting on not the most common or whatever, but the ones that are sort of higher level. I assume when you get into the weeds, there's even more challenges. Would that be fair to say?
Yeah, and it just is FHA in particular that gets weird. VA is, on the other hand, is much more liberal. So VA, for example, your old loan or the house you're leaving, we call it the departure residence. The veteran, all they've got to do is say, I'm going to rent it out. I'm going to rent it out for about $2,000 a month. We don't need a lease. We just need the veteran's words. Now, it has to be reasonable. So if the veteran says, hey, it's $5,000, then I'm going to rent it for in a market that typically is $2,000, that's not going to work. But if it's a reasonable amount, we don't need to get a lease or verify that he got it or he or she got it rented out prior to the closing on the new purchase. So very, very different rules from one program to the next. It's a situation where really it's a critical part about getting pre-approved is super critical because the guidelines, they don't all make sense and they're all really varied from one program to the next, depending on what you have for current financing and the kind of financing that you're trying to get approved for. Don't make assumptions about what you think is going to work because until we go through it in a pre-approval, there's no way to know for sure what you qualify to.
Yeah, especially after watching videos like this, which is great information, and yet it's fairly broad, right? We need the person to apply with you and have you go through the scenario specific to that individual or more broadly couples or whatever, but to the borrowers and see if they actually can do what we're describing. Peter, I want to pivot just a little bit if you're okay. So is there anything else you want to add about the program specifically?
No, I'd just say that I want it to be a message of hope that, if you've got this situation, don't immediately discount that you don't qualify. Don't immediately make those assumptions. Let's talk because we might be able to use these kinds of tricks in order to help you qualify for the new house.
Sure. Perfect. And if our intention as a homeowner is to convert that home into a rental, there are ways to do it even if we don't qualify. You've touched on a couple of those. Let me ask you this. How might we get, if we're going to do conventional or FHA for that matter, how are we going to get a down payment? If we're not selling the home, so many people are pulling that equity when they sell their home. What are a couple of ways, and again, it can be fairly broad, but what are a couple of ways that people are gathering money for a down payment?
There's a long answer to that. I'll give you the short answer. Bridge financing is one way. So if you don't have the cash in the bank, then getting a bridge loan, and that is typically a second mortgage on your current house in order to extract some of that equity to use as a down payment on the new house you're buying. That is one way to be able to do it. There's also sometimes I work with buyers in multiple ways. So they're going to do a combination of, they own a car free and clear. We're going to do a car loan. Maybe they've got a 401k and we do a 401k loan and they get a gift. And so we use a combination of things in order to finance it. So really depends on a buyer's scenario, but there are varied ways of coming up with a down payment.
Sure. Yeah, perfect. A lot of people think they have to save for the down payment. Is there also like entry cost assistance available in this scenario where you're keeping a home and then buying another one? Is there government programs that help these homeowners too, or is that not an option?
Yeah, under limited circumstances, you bet. Through the Minnesota Housing Finance Agency, they've got a program called Step Up. And if you're leaving one house and buying another, here again, it's tricky, but as long as the old house is not a Minnesota Housing Finance Agency loan, now we buy the new house with MHFA financing, and now you can get up to $14,000 towards your down payment assistance or as down payment assistance, as long as you own only one other property, you could use that. But that's a unique program. There's nothing else really like that.
Yeah. Well, all of this stuff is sort of unique, right? At the end of the day, if you're interested in renting your current home to make your next move, you're feeling rate locked, you don't want to give up that 3% interest rate, what have you, whatever the reasons, but you do want to make a move, you desire a move, this seems like a really good option for people. And of course, there's tons of different ways in which we kind of make the financing happen. And this video touched briefly on it. Is there anything else, Peter, that you want to add here? And then we'll wrap this one up.
The only thing that I'll add is don't make assumptions. It's too complex. I talk to people using this analogy is that it's like walking on lily pads over a pond. We have to look at these little ways that we take step by step to see if you end up qualifying. It's really impossible to just lay it out. ABC, here's what you qualify to in a video. So let's talk if this is your scenario.
Perfect. Thanks, Peter. Really appreciate your help today.
Thanks, Travis.